Welcome, and in this guide, I'm going to walk you through how to set up QuickBooks SoloPreneur. If you had a chance to review some of the plans, you'll see that online options offer Advanced, Plus, Essentials, and then we have our SoloPreneur, which used to be Self-Employed. So I've logged in already here and I'm on the main dashboard screen. If you had an opportunity, usually when you sign up for an account with QuickBooks SoloPreneur, it'll walk you through kind of a setup process. It'll ask you a few questions to try to set up QuickBooks for you. Now, it doesn't really necessarily matter how you answered those because you're able to come into QuickBooks and adjust those settings. And so I'm going to walk you through some of those settings right now that we can change and that we need to make sure are set up appropriately for our QuickBooks SoloPreneur. Now, this QuickBooks SoloPreneur setup is going to be based on mostly real estate agents, like individual real estate agents. But stick around if you're not a real estate agent, because a lot of the tips and stuff that we are going to go over will apply for a lot of several different 1099 type of contractors or self-employed people that are similar to real estate agents, such as like insurance agents and those kinds of things. And even if you're not, you can still gain some insights into that. So the first thing in the upper right-hand corner, you see a little gear icon, and that's where we can access a lot of our settings and our profile to make some of the adjustments that we're going to need to make here. So one of the first things, if you go under profile, you're going to see account and settings. Go ahead and click on that. That'll take you to your account settings where you can kind of set up some of the accounting side of things, your legal structure, and the accounting methods such as cash and accrual. So the first screen you're going to be taken to is the company screen. Here you can enter your company name, insert a logo if you want, as well as your legal name if you have one. If you don't have one, you can leave this blank and just leave it same as company name. Now your company type, it's very important to understand that when you're asking your company type, there's a difference in what's called your legal structure and your tax structure. And in this case, the tax form, where it says tax form, your company type, they're really asking for your tax type. Now, you can be taxed in a few different ways, and you can be set up legally in a different way, and then taxed in a different way. So it's important to understand the difference. If you're unsure, it's a good idea to talk with your tax advisor or accountant. But for real estate agents and a lot of 1099 or like self-employed contractors, you're often just going to be categorized as a sole proprietor unless you've gone through the process of, say, setting up a LLC, a limited liability company, and then took that LLC and designated it as a S corporation tax. Even most LLCs will still be taxed as a sole proprietor and show up on their sole proprietor. And it's not always the case, but just keep in mind, it's probably going to be the option that you want to choose for yourself. And then you can go ahead and enter industry, hit save, and then enter obviously all your contact information if you'd like. QuickBooks checking, you can skip that unless you need to open up a bank account and you want to, do your QuickBooks bank account there. You can go under the sales section, but for most real estate agents really aren't going to use this section. So honestly, there's really nothing you have to do here because all of these options can be left alone. As I don't know any real estate agents that are necessarily invoicing their broker or anything like that to get payment. So it really doesn't matter. Payments, this is if you're going to collect or receive payments. Again, you can really bypass this section as a real estate agent because you're not going to be really collecting payments. Obviously, most brokers will just direct deposit or do ACH, or they'll do a check to pay you, or maybe you'll get it from the title company, whatever method you're going, or whatever method that is, in your state and how your broker's set up. But we're obviously going to go ahead and skip this section as well. And then under the advanced section, we're going to select some of our accounting stuff. These are just some preferences that we have. So most fiscal year, everybody's pretty much going to be on January to January unless you have some reason that you set up a fiscal year as different. I don't typically see this, so I just recommend going with January to January so that you can file your taxes when you need to file your personal taxes. And the accounting method that's best to use, there's two different kinds of accounting methods. You have cash and accrual method accounting. There's some rules where you have to use accrual, like if you have inventory and stuff, but obviously real estate agents don't have any inventory or anything. So I believe the best method of counting is cash accounting for real estate agents. It's usually the easiest to understand. It's the easiest to work with because you can understand your, you can understand your profit and loss statement easier. You can understand, you can see how the money's flowing versus trying to account for and recognizing revenue even though it hasn't been collected. So the cash basis of counting, it's important to understand that basically we're recognizing expenses and revenue when payment is exchanged, and that's how that's usually the easiest method for people to understand. Now here you can change if you have any preferences towards the time and date and the money, how it's configured. If you want to refer to your clients as your customers as clients or customers, donors, guest members, etc. I'll just categorize them as clients. And you're good to go. So that's how you set up your account settings to make sure that they're configured appropriately and correctly. Here, just going back over into the gear icon, subscriptions and billing, that's just to change anything that you need to change. Here, obviously, is just any feedback that you want to offer. Tools here are for you to import and export data. You can see there's different kinds of data that you might need to import and export, like your bank statements and stuff. But the next thing we'll set up is our tax profile. One of the things with QuickBooks SoloPrenuer is that it does try to estimate, how much taxes you're going to have due or have to pay on a yearly basis. So it's a good idea to set this up and to make it as accurate as possible, as much as you can. So the first thing you're going to select is your marital status. If you're single, and say I'm married, so I'm going to do that. I am going to file jointly. My number of dependents, I'll just say, let's say I have 4 kids. And then your W-2 income. So obviously I'm married, so it's going to have my W-2 income plus my spouse's W-2 income. So let's say I'm working as a part-time real estate agent. I'm doing whatever business I'm doing part-time, and I have a full-time job that pays me $72,000 a year or something. And then see here, And what QuickBooks is going to do is it's going to go ahead and estimate for you. If you see here, this is your not our estimate of $48.76. It's going to estimate how much tax withholding you should actually be withholding based on that income. So I'm going to say, let's just say that, let's say I'm going to go ahead and withhold $48.76. And then let's just say my spouse also has a job making $45,000 a year. It'll automatically calculate the withholding for that as well. And you'll see that what ends up happening actually is there's an increase in our taxes here because we've increased our income as it's taken both of them. Now you have 2 options. Obviously, you can enter the estimate if you are unsure. And the other thing you could do is actually enter the withholding that you received last year. So if your income really hasn't changed or your income is about the same because you're working like a salaried job or you expect it to be the same, it might be a good idea to go ahead and enter the withholding, the W-2 withholding that you had held from your job last year. And that'll help kind of offset or help calculate more accurately what you may owe based on your current withholdings at your job. So you can go ahead and save. And it likes to do that. A little bit of a glitch, I think, in the system there that it does. And so that basically is the main settings that we need to set up and take care of. And so let's go ahead and move on to the dashboard that we originally saw when we first started this video. Here, just getting familiar with the dashboard, we have our cash balance. you can read how it's calculated. Honestly, I don't really like the way that the cash balance is calculated because it kind of leaves a lot of information out, and so I don't feel like it's a very good estimation of your cash balance, especially if you're holding on to cash. So because it only takes the linked bank accounts and cash that you've manually recorded, but it doesn't take anything else that you might have, like unlinked bank accounts or credit card and loan balances or anything like that. So it's not it's not really a good reflection of your cash balance, I feel like. So excuse me. So I don't I honestly I try not to look at it, or don't really recommend looking at it too much. You know, I know the effort there to try to get a good picture of your cash, but you know, like it can add up to a negative, especially if you're using credit cards as a way to process some of your transactions. So it's extremely difficult in terms of like if you're using credit cards, because it doesn't link credit cards. If you're using that and then paying off the credit card with, you know, the money, so it's not a really great cash balance offer. Here you can see your tips if you have any, like how to use more out of the product and you know, use QuickBooks SoloPreneur. For most real estate agents, I'm not going to dive into it because, like I said, this video is more geared towards real estate agents. We're really not going to be using invoices or estimates, and you're most likely not going to be using customers. But if you are, you can go ahead and set up customer right here by clicking this customer button. Or alternatively, you can go ahead and hit new, and you can also add a client here with this button and function as well. And so you can add customer, or you can import them manually if you'd like. Moving back to the dashboard, we have our kind of our widgets that we can call them, and these are pretty good. I do recommend simplifying this, just removing some of them if you can, if you would like. Really, if you look at it, because we're, again, not going to have a lot of invoices, or there will be no invoices, you can usually remove this income widget and take that off. All you're going to do is customize layout, add a remove widget, go to income, and go ahead and hit save. And you can go ahead and hit done. If you wanted to move some of these, you can move these as well to kind of configure them to the layout that you like. You know, then you can see how here, if you reorganize this like this, you can look at your profit and loss and compare that to your taxable profit, which is a good idea. So I recommend at least these 5. You could consider removing the bank account if you don't really want to see, you know, how much is in the bank account or what those bank account balances are. And that's the dashboard for you. The next, and probably the most important, is bank transactions and the bank feeds function here. So once you've done that, you're going to go to transactions, and you can go ahead and enter transactions manually, or you can set them up through bank feeds, or you can upload bank transactions as well. So we're going to look at a couple options here. If you want to upload your bank account, you can go ahead and hit link account. And then you would just follow the prompts to link your account, whatever bank that you have. If you were looking to upload your bank statements, let's say you are worried about data security, so you don't want to connect your bank manually, you can always drag and drop your files or select your files and upload in a CSV format. So as long as you can download the CSV format from your bank, which is kind of like an Excel file, you'll be able to upload it here into QuickBooks, and they will upload the transactions for you. And if you need to enter a transaction manually, let's say, for example, one of the biggest reasons you might enter transactions manually is if you're keeping or recording cash for some reason. Maybe you're making expenses with cash, or you're making maybe you're getting income with cash, which doesn't usually happen in real estate, but if you're, again, watching this and you're in a different industry. So, you know, to record a transaction, we're just going to select whether it's an income or an expense. Let's enter an amount. Let's say it's, let's say we spent $100. We spent it today. We could write who it was to or what it was for. So like maybe we spent it on Zillow, obviously, I don't know, and advertising and marketing, and hit save. And there you go. There's your transaction recorded. So that's going to be the simplicity of it. Now, when you import or when transactions are imported, they're going to try to be automatically categorized based off of either past categorizations that you've done or, basically QuickBooks best guess. Now, one of the limits that I think Solopreneur has is the chart of accounts. Unfortunately, there's not a whole lot of options when it comes to chart of accounts. So you really just have to do your best to manage and kind of pick the category that you think is most suitable, because sometimes you might have an expense that you don't really think fits, I guess, with any of these categories. So you'll have to do your best to categorize them. And if you're uncertain, obviously it's a good idea to, consult with an advisor, a tax advisor, or a bookkeeping pro to figure out how you should really go ahead and categorize these. So, and then just to show you too, I'll show you back out of this. I'll add a new transaction because I do want to show you something that happens when you hit income. We're just going to say it was for sales. And when you're categorizing income, generally, you're just going to have to put it under the sales category and hit save. Well, you'll see when income comes in, obviously it shows up green, and all of the expenses or things that are going out show up as black and with a negative. So that's a good way to see the different kinds of expenses. So, and next, if you have a large list of expenses here, obviously you have filter functions that allow you to filter out the different kinds of transaction types. So if you want to see income versus expenses, you can do that. And if you want to see, the different kinds of categories that they're categorized as, you can do that as well. And that'll help you hopefully be able to go ahead and quickly categorize your expenses, because obviously it's easy when there's only 2 transactions, but if there was more transactions, that might be a little bit more difficult. So, and the other one that I want to talk about here is some of these categories, it's important to understand, won't be linked to your profit and loss statement. So we'll kind of dive into that more, I think, when we start talking about vehicles, adding vehicles, mileage, and home office deductions and things like that, because it's important to understand that not every category is going to be linked to your profit and loss statement. And that can be kind of one of the downfalls of solopreneur, is understanding this difference between taxable profit versus what the profit and loss statement is showing, and then keeping track of different things, especially like assets. From an accounting perspective, generally assets that we expect to last longer than a year need to be depreciated against. And in QuickBooks SoloPreneur, there's really not a good way to track and keep track of depreciation and record depreciation into your profit and loss statement. And so it can kind of be, I guess, problematic and stuff and not totally transparent on your financial statements. So if you are uncertain, I know QuickBooks does have a great guide on what transactions or what chart of accounts are linked to different, whether it's linked to the Schedule C or not, and whether it's linked to just the profit and loss statement. So that summarizes our kind of our transactions. We'll add some more transactions as we're going through and looking at vehicle tracking and home office deductions. For now, let's go ahead and move on to our mileage. So if you're new, you'll have to set up your mileage. You can download the app. For now, I'm just going to skip for now so that we can set up our car. If you go over here, you have to look at managing your vehicles. You can click manage vehicles here, or this drop down, you can select manage vehicles. It'll have your vehicle. Usually it'll just say primary vehicle when you first start. Go ahead and enter the make and the model, the year, whether you own or lease this vehicle, the date you bought it, and the day you placed it in service. And so which tax info do you want to use? generally you want to use this first option, by business use of the vehicle. This will help you take a percentage of the business, or a percentage of the mileage for the vehicle. Most solopreneurs and real estate agents, for example, will be using their cars both for business and for personal. And this allows you to estimate the percentage that you're going to use for business versus personal, because that's going to influence, come from the tax perspective. It's going to determine, or help us determine, whether we should file for a standard deduction, or we may want to file for the actual expense deduction. And those are the two different ways that we're able to properly deduct our expenses inside our business. You can do it by recording odometer or by entering the total miles, but generally by recording the odometer, that kind of assumes that you're using the vehicle only for the business. Otherwise, it's going to, because it's basically going to take everything, all of your mileage for that, and deduct against all of that mileage. So it's not really a good option if you're using your vehicle for both personal and business. Now, obviously, if you download the app, there is an option to track your vehicle tracking manually. You will be able to auto track your miles. All you have to do is log into the app and enable the mileage tracking feature, and it will take care of that for you. It'll automatically import all of these trips in here as unreviewed, and then you have to go through and review them and state whether they're business or personal. Now, should you use auto tracking or not really depends on how many miles you're driving from both business and personal. I tend to recommend that if you're doing a lot of driving on the personal side, it's not really worth using the auto tracker, because you're going to have a lot of unreviewed transactions. Like if you're going to the grocery store, dropping kids off, doing all these things, picking kids up from school, and you're making like 6 different trips in a day, but you're only driving 2 times, like maybe a week to visit a client or to show some houses, well, you're going to have to filter through all of those trips just to record the 2 that you took. So it might be a little bit more of a better option to not turn on the auto tracking, but using the app to track it when you're actually making a business trip instead. So if you need to add a trip in the computer, you can do so manually. I'm just going to give you an example so we can look at it from a perspective of, let's say I was meeting with a client. So I'm going to give you an example so that we can see how it affects our profit and loss statement and our taxes. So I'm going to hit save. So I drove 45 miles. As you can see, the current tax rate is 67 cents per mile deduction. So that if we drove 45 miles, that allows us to take a deduction using the simplified or the standard deduction of $30.15. And so if you go over here, business, you can see our business trip is here. It's recorded. Let's say we met with a client and we showed them a home. Other functionality that you have is you can manage favorite locations, which is great, to allow you to quickly enter locations and names rather than having to type addresses all the time. So if you're regularly driving to and from the office, in a way, your office, to show a client a home, you could definitely use that to be able to quickly add your location in your trip settings and stuff. So it's much easier. So I'm going to go back to the dashboard because I want to take a look at how we've added 2 transactions. We've added some income. We added some expenses, and then we took our auto mileage. So I want to show you just a little bit on how that is taken into account. So obviously here we have our profit and loss showing up as -50 because we made $50 and we spent $100. But what you see here is we spent that $100 in marketing, if you remember, and there wasn't any expense here that has been accounted for with the mileage that we've taken. So we can see kind of the impact of mileage when we go to our vehicle expenses, and we see our deductions here. you can see that our deductible expenses are $100, which was our advertising. And then we have our vehicle expenses, which was $30. Scroll down here, you can see the 45-mile drive that we added with the 3015. And then you can see your actual expenses. Now, we haven't recorded any actual expenses here yet, so we're not really showing anything here. So if you're thinking about taking an actual expense method, or you think you might want to take it, the only way that you can really record it is going into transactions, entering a new transaction, let's say an expense. Let's say we spent $25 on fuel. Really, I drive a Prius, so it's probably more like $5. And we're just going to say fuel. We're going to categorize it as gas and fuel. And then we'll go ahead and hit save. And then what you'll see is if we go back to those taxes, that $5 hasn't been recorded. Because keep in mind, we can only take the standard deduction, or we can take the actual expense deduction to be recorded from a tax perspective. So the only issue with QuickBooks is that it's always going to calculate the standard deduction no matter what, even when the actual expense is higher, which I wish it would calculate your actual expense or the actual deduction or the highest deduction, because that would give you a better indication of what your tax liability may be. Because if your actual expense comes in significantly higher, then it's kind of problematic in the basis that that is going to over-report how much you owe in taxes, and so you're going to have to get issued a big refund, and you're not going to have that money throughout the year to spend on marketing or growth for whatever your business or your real estate business. So I'll give you an example because we'll run through this transactions again, and let's add some more. Let's say we spend $500, and let's say we just got a new loan. We purchased this car with a loan, and a majority of it, let's say our car payment's actually $550. Let's say our car payment is $550, with $500 of it going to interest, and we'll say $550 of it actually goes to the principal balance. Our car. Let's see here, vehicle loan, and save. Now, if we go back to our taxes and we look at that, you're going to see that our actual deduction is going to be higher than our standard deduction, as you can see at $151 versus our $30. Now, how's this $131 calculated? Because we had our payments here and our vehicle loan interest, and it looks like it's a percentage. Well, if you remember when we set up our vehicle, I'll go back to it. We set up a percentage. We estimated a percentage of what our trips might be. And so we estimated our business mileage here as a percentage, and that's where it's calculating it, and we entered it in there. Now, granted, you're actually going to be able to calculate a percentage because as you add mileage here, for example, let's add a trip. Let's say it was also 45, and let's say it was personal use, and we hit save. Then we can calculate this function right here by taking this number, total business miles, divided by our total miles. In this case, it would be 50%. Now that we've seen how our taxes are affected, though, the difference is that I do want to show you is the difference between our profit and loss statement. Because you see that if you take our $50 income and subtract it from 130, then technically our taxable profit would only be negative, what is that, negative 80. But our profit and loss statement here shows negative 50, 555. And so you have to think about what expenses are actually calculated. And that's where sometimes this QuickBooks SoloPreneur can actually get confusing because it's a little bit how this profit and loss and taxable profit is all calculated. And so it's important to understand, but it's very, very easy, I think, for a solopreneur because we got a lot of these kinds of heavy expenses that are deducted differently. So like for a real estate agent, you're going to be heavy in you may be heavy in your mileage expenses, especially if you're just getting started and you're like a new real estate agent. You might only have a couple sales or something like that. So it's extremely it can get really confusing trying to figure out which numbers to use or which numbers to make decisions off of. So I just wanted to go back to the transactions, and I wanted to enter the income amount closer to an amount that would be similar to a commission check, just to show you how our profit and loss statement too is changing. So for some reason this didn't change. I don't know why that didn't change. It needs to be refreshed. But let's go back to income tax. And you can see our income is 2,000. Our taxable, again, is only taking the standard vehicle deduction for a taxable 1870. So keep that in mind. 1870 is what we're going to be taxed on. But if we go to QuickBooks, we only see 1395. So it's important to understand that difference, that even though our profit and loss statement may be lower, we're not going to necessarily be taxed on the same amount, because it's all going to differ how certain expenses are actually deducted come tax time. And so we shouldn't be looking at this profit and loss statement to figure out our tax liability, but our taxable profit. Alrighty. So let's move on to the home office deduction. If you go under income tax and scroll down past our past the vehicle expenses, you'll see home office. And that's where we can add our home office deduction. Just like the vehicle, we have two different methods for adding our deductions for our home office. We can use the simplified version, which just takes $5 per square foot of the designated office space. Or we can use the actual expense, which does something similar to the vehicle, where it takes a percentage of the home, percentage of the office space, as it relates to the home. So for example, if you have 100 square feet designated as an office for an 1,000 square foot home, that's going to be 10%. You can go ahead and set that up by clicking on your current home office. Now, before I go into that, I do want to talk a little bit quickly about whether or not you'd actually be qualified for setting up the home office deduction, because for real estate agents, it can be a little bit tricky because the IRS says that it needs to be used as a primary office. If you kind of scroll here, right here, this dashed underlined, it says that you need to use part of your home for your business. You don't use the area for personal activity, so it can only be used for business. So you can't conduct personal stuff in it, whether it's like playing or doing personal research or anything like that. And it's your main place of work or where you meet clients. And so that can be a gray area, because obviously many real estate agents have opportunities to work at a broker's office, and also they very rarely meet clients inside of their home. So you really do need to consult with probably a professional to make sure that, based on how your current work setup is in your work settings, that you actually can qualify for this home office deduction. But let's assume you do, and you're going to go ahead and enter your square footage. Let's say we're using 144 square feet, average bedroom, 12 by 12. That's like a bedroom, 12 by 12 bedroom. And you can obviously figure out how to, here's some extra questions of whether you qualify, how to measure it, et cetera, et cetera. So if you go to this, your home office, it says principal location of your business, or a place where you regularly meet with your customers or clients, or a separate structure not attached to your home. So again, super gray area because of that, because we very rarely meet customers at our houses. We actually may meet customers at the broker's office, which could be, before we start showing them houses and everything, which could be made an argument that your home isn't your primary place of office. So your square footage is going to automatically calculate as your deduction at 720 if you're using 144 square feet. Let's say, yep, we have a square footage of our home is, let's say, 1,600. Then we're going to use the basis of 9% as what it's going to do to deduct from our actual expenses to sort of calculate what that deduction would be. You hit save. You can see from your home office deduction, 720 is recorded. Just like the vehicle deduction, it's going to automatically take the standard deduction, even if the actual expense or the regular method is higher than the standard deduction. It's not going to record the standard deduction. It'll record it down here, but you won't see it in your taxable profit. So let's go ahead, add some transactions just to show you how it would change. So some of the expenses, obviously you could see the categories that were in there for the home office deduction. It's going to be like your rent or insurance, interest, property tax, rent if you have a rent and lease payment instead, any repairs and maintenance and utilities. Now repairs and maintenance, it doesn't as long as it doesn't add value, it can't be construed as anything that would be considered an improvement to the property. Let's go ahead and go to transactions. Let's add a new transaction. Let's say as the same case of like our vehicle, we just bought our home, so we're paying a significant amount in interest. Let's say we have a $1,000 mortgage payment with $1,000 going to interest, and 50 of it is going to, let's say 50 of it is going to the principal balance. So we have $1,000. And so what's going to happen is our profit and loss statement now is going to show $1,000 taken out again, which it does. Our expenses are now 155, and our principal balance won't be adjusted by, or I should say, our profit and loss statement isn't adjusted by principal balances because principal balances aren't considered expenses. So you won't see a mortgage, especially if it's towards the principal balance, isn't going to show up on your profit and loss statement, nor will it show up on your taxable profit. But what is deductible is the interest itself. So if you scroll down here to your regular method, you can see that we did 950, which was the interest amount, and that was $85 for $85, for that would be for the month. So if we multiplied that by a year, multiply 85.5 by 12, I don't know what that is. So we'll go back to transactions. Let's just edit it to show you. 95 by 12, I don't know, that's, I think, 11.4 if I did my math right. I don't know. Let's just go with it though. And show you our income tax. Scrolling back down to our home office deduction. And you can see that we spent $1,000, or that would be our $1,000 deductible or deduction. And you can see it's more than 720, but yet obviously QuickBooks is only ever going to calculate that standard deduction. So, it can really fool you whether or not, which amount to use, and doesn't do an excellent job necessarily at estimating your full taxes. So which method should you use, I think, is a quite common question that I get. I think it really depends. Obviously, it's like run both the numbers if you really want and track them. And generally, you'll find that people who are early on, and especially if they have a loan or a mortgage on their property or on their car, they tend to be better. They tend to have a better time or a higher deduction using the interest method or the actual expense method because of the high amount of interest that is generally paid early on for a car or a mortgage, for example. And so while we're on the income taxes tab, I think it's beneficial to go ahead and go through all of this information that you'll find on your taxes tab. We've already looked at a lot of the income section, but here you'll find everything related to the taxes in terms of your income, and then your deductible expenses, vehicle, and home office. This is the simplified version if you just want a quick look at it, but you can get a more detailed view by expanding all of these boxes. So we've already looked at the vehicle expense. If you expand it, you can see, the standard deduction versus actual expense. Same with the home office. If you expand deductions from your transactions, you can see it's the $100. Any of the categories that we used are going to be set up here and deducted. So you'll see, spending, we spent $100 on marketing and advertising. So you'll see the $100 deduction. The only thing that really is different is meals and entertainment, because meals are only deducted at a 50%. So if you go get coffee with a client, let's say, for example, let's go here. Let's say we meet them for coffee and it's $5 that we pay for their coffee. You know, maybe you're going on a listing presentation or something and you're going to do it at a coffee shop. We'll hit meals with clients, save. Go back to that income tax tab. Scroll down and you'll see that we only took $2.50. So something to keep in mind when you're, again, looking at your profit and loss statement versus your deductible, your deductions for tax purposes. Here you have your healthcare expenses if you have any of those. Here you have business assets. It'll keep track of your business assets, but it doesn't do a very good job. So like it keeps track of it so your accountant or your bookkeeper can track your depreciation and deductions and stuff from it. But inside the system, it really doesn't do a very good job at doing it. Let me give you an example. You're a new agent or something, and you buy a $2,000, I don't know, Apple computer, desktop computer. That's just, amazing. And see, computer, that's greater than $200. And we're going to go ahead and save. And what you'll see is when you come to your income tax here, it's not deducted from your expenses because assets generally need to be taken into account. Assets, which is what this computer is considered, usually need to be depreciated over their lifetime use. So like a computer doesn't usually last only a year. It might have a lifetime value of about 2 to 3 years. And so technically you're only supposed to take, let's say it has 2 years, a 2-year deduction or a 2-year lifetime value. You would say that the computer should be deducted from the expenses at a rate of $1,000 per year because you didn't really incur you're not really using the property or incur the cost of a computer up front. So something to keep in mind because you won't see it affect. And again, when you add some of these expenses and things like that, it's going to overstate actually what you're going to be taxed on. So do take this tax estimation on with a grain of salt. So that's the deductions. If you actually want to see the tax estimate, you can click on the tax estimate tab. And then you can see what you might owe in self-employment tax. And then the total income tax that you're going to have to pay. And then you can see what you may actually be needing to pay for the entire year. And keep in mind, this is only federal tax. So really, depending on your state, if you're in Florida, I believe Florida's at a 0% tax for the state tax. So, you're probably okay here. You just got your federal tax. But if you're in a state with like a flat rate tax, keep in mind that you're also going to owe taxes on that. And keep in mind, if you're in a progressive tax, it's going to be a little bit more complicated because you're set up based on, your income. So your tax bracket's going to change as well. I think there's definitely a room for improvement when it comes to the solopreneur and setting up the tax bracket or the tax estimation thing. You may want to use a tax estimation calculator or something outside of QuickBooks to get a better estimation because it really doesn't do a significant job at determining your tax liability. See here. And so yeah, that's one of the negatives I think with this. Oh, the thing I wanted to mention was that this estimated tax, keep in mind this is the estimated tax for the entire year, and generally you're going to be required to pay taxes throughout the quarter. So if your estimated tax is $381, for example, generally you're going to want to pay a quarterly estimated payment. So that'd be $381 divided by 4. For simple math purposes, let's just call it, that's like $95 approximately per quarter that you're going to have to pay, which is usually due somewhere around, it can change depending on the weekend and stuff, but it's generally April 15th, July 15th, September 5th, or no, that'd be October 15th, and then January 15th. So that will be how you change your quarterly payments, or you'll have to make your quarterly payments. The last thing I want to talk about was customers and goals. Here you can set up your goals. based on your GCI, like your sales income goal. So it's kind of cool if you want to track a little bit more of your your GCI goals or production goals. So we can come in here, we can set a goal. Let's say I want to grow my income. Let's just say, GCI. How much do you want to make? Let's say I want to make $75,000 GCI, and I want to do it by, within the next year, roughly. So we'll just say March 31st. And, which path do you want to try? It doesn't really matter. You can try offering incentives or getting customers. Alrighty. So then you can see your goal, and you can track your goal along. You can update this goal. You can change this goal as you go along and stuff. And then it gives you some helpful tips if you are looking about how to expand. Of course, there's no shortage of tips and stuff anyways on the internet on how to increase sales and do all that stuff. But it gives you a little progress bar that you can see. Usually this is supposed to calculate months left, but obviously there's a glitch in the error in the calculation to see the timeline. But yeah, you can see with a progress bar, every time you add sales, then you will be able to track how you're doing against your GCI. I think that's very helpful for a lot of real estate agents that are setting their goals and everything like that. And there you have it. That is our kind of QuickBooks Solopreneur module. I know that, we didn't really go over invoicing and customer sales. So if you're not a real estate agent, there are probably other videos about it. It's fairly simple on how to use it, but I'll go over it real quick in case you came from a non-real estate. But if you're a real estate agent, you can pretty much end this video and be done. But let's go ahead and go over invoices real quick. So you can add an invoice either from the new button or by clicking the invoice button. And then you just fill out your invoice, add a customer name, add new customer, say Jim. We won't add anything else. We'll just call him Jim. And then we can set net terms if you're going to collect, most solopreneurs, you should probably just have due on receipt unless you are running, maybe you're a web developer or something like that. You may want to offer net 30. What this means is kind of when it's due from receipt. So if I give you a receipt today, I don't expect payment within 30 days. So today is, 6/6/2024. You can see that it automatically calculates the due date for them. And this is when you would expect to be paid by. Here you would add a product or a service. If you don't have any, or you can write it. Let's say I bill at, $20 an hour. I don't know. And I worked 1 hour and there's my invoice. I can review and send it. And then I can print and download it. Maybe I send it through the mail. And there you go. They would be, obviously sent the invoice and send it new. So I would enter the email address and that would be that. And then I would have an invoice. If you did want to track your invoices, again, obviously you would come back to your widgets here, enter income. And this would show you invoices that are due, invoices that need to be paid, invoices that are past due. Obviously, we have an open invoice. As it moves past that 15-day, it's going to become an overdue invoice, and then it'll track my paid invoices in the last 30 days. All right, there you have it. There is our QuickBooks Solopreneur setup guide.